great to see you this morning. Sharing the disclaimers with you that if you wish to remain unidentified, remove your name, your face from screen view. We don't have any crystal balls. This is my opinions. Stock investing includes risk, including the fact that you can lose money. The discussions we'll have today will be historical ones, and they in no way project or predict the future. They just give you an example of the risk and the opportunities associated with stock investing. This is for general information, not intended for specific advice. This is, again, it's all reference to historical and no guarantees. These thoughts and opinions are those of Gimbal Financial and do not represent LPL Financial. Securities are offered through LPL Financial, a member FINRA and SIPC. If you go outside, you can get hurt, so be careful out there. Life is risky, okay? How's that? We get all the disclaimers in place. I am excited to go over this with you this morning. I last week was talking to you guys about tennis balls, and that you want to find stocks, if you're buying stocks, that are going to do this kind of action. When the market drops, you want to see them come back quickly and not act like eggs. So remember, tennis balls are the way to go. These are, I think, Walmart brand here. So there you have it. I want to talk about the importance of risk management today and learning that you can lose money in stocks. And you can lose money because they can go down in value. And along with the ability to lose money, you have a time value of money. Time value just says the longer it takes me to get a certain rate of return, the lower rate of return I'm going to get. So you want to keep your rate of return time cycle as short as possible to increase your rate of return. So let's take a look. I'm just going to talk you through a single stock here, and I want to relate this stock to today's markets. Today's markets, everybody's excited about companies like Facebook, Amazon, Apple, Netflix, Google, Microsoft, and I'm sure there's a few others that are in that same category. These things tend to lead, and they lead for a period of time, but they don't lead forever. So that's a critical thing to keep in mind as you're looking at investing for the long term, is that your long term may be shorter than you expect, that you need to take profits in order to make money. So I'm going to share my screen with you with a company that was a high flyer, just like Facebook, Amazon, and Netflix are today. It was in the day. Those of you that are not as familiar about this company, International Business Machine, is known as IBM. It was the Facebook, Amazon, Netflix, and Google of the 1960s. So what I'm going to do here is I'm going to go back to 1962 here and show you what happened here. This thing became what we call a public stock in July of 1962. That's what an IPO is, initial public offering. They were the tech gurus of the 1960s and 70s and so forth. They went from this 340 level when they went public all the way up in a short period of time to August of that to about 475. That was close to about a 40% rate of return in month and a half. And that's the sort of activity that attracts people to want to get invested in initial public offerings. Initial public offerings can be very risky because you might have been the guy that bought right here at this peak at about 415. And then just a few weeks later, your stock was down to 340. So this is International Business Machine, been around since, before this time. And we're going to just spring forward. We're going to look at this on a weekly basis and just see what happens on a weekly basis. So there's 1962. Here's 1963. Had a nice run, ran all the way to 500. Here we go to 1964. It peaked out there at that level, but again, it was a leading stock at the time. 1965, it's over 500. 1966, it looks like it dropped, but it did. It must have done it. You can see it right down here. I don't know if you can see it on my chart right here. It's right there. It says a 5-for-4 split, and here's a 3-for-2 split. That's where the corporation gives you extra shares of the stock, but when they do that, the stock price drops. It might be like if you had $1 value of something and I just gave you 4 quarters, or if you did a if you did $1 and I did a 10-for-1 split, I would give you 10 times. So that's what all a split is. It doesn't change the amount of money you have, it just changes the number of shares you have, and the market itself adjusts the stock price according to those splits. Normally, when you start seeing a lot of splits, it gives you an indication it might be a riskier situation than it was before. That's because it's trying to attract more investors into the stock. But anyway, we'll just keep going forward here. We'll add another year to 1966, 1967. This thing is shooting up like a rocket. It's up over 600 after having 2 splits over here. And then we're going to go to 1968. 1968, it finally peaked out. Let me see here. So this thing went from way over here to the left of the screen, that's below the screen, all the way up to $400 a share after the splits. And you can see right here it had a 2-for-1 split. So that thing just rocketed its stock price up. And so what I was doing in my notes was to say, what if you bought in the high of 1962 of this stock? I'm going to show you on a monthly calendar or chart here. You can kind of get the feel for this thing. So if you bought it right here at this level, the high in August of 1962, and you're just wise enough to come over here to June of 1968 and sell it at the high, your annualized rate of return during that period of time would have been 23% a year. We talked about a few weeks ago, there's a thing called the rule of 72. You take your interest rate and divide it into 72, and it tells you how long it takes your money to double. At a 23% annualized rate of return, it doubles your money every 3 years roughly. And so you can just see the power of something like that going on in a stock on your behalf. Let's go back to the weekly and talk through it a little bit then. So we're at 1968, and what happened is this peak right here was the end of that rally in that stock. So I'm going to jump forward to 1988 now. We're going 20 years forward. And let me look here. I got to show this to you on a monthly. All right. So here's 1968 right here. It did peak for a little bit over here, but I just skipped that. I said, when did this stock peak? Where it just, from that point on, never looked back. And so it went from 1968 to 1982. Right about here in 1982 is where it hit the level that it previously was in 1968. So it went 14 years and earned 0. From June of 1968 to October of 1982, you got 0 on your money. That's not a very good time value on your money. And a lot of people did that because they believed IBM was the greatest stock, because they heard that during the 1960s. But from 1968 to 1982, it was a horrible place to have stocks. However, had you bought it in 1962 and held it to 1982, you would have got an okay rate of return. You just wouldn't have done as stellar as you had done during the 1960s. So then if we did happen to get out of IBM over here and we're looking for the other companies that came to their own light at that point in time, we could have had this one pop up on our attention level over here in 1982. And had I bought it at that new high in 1982 and held it to this high over here in 1987, from that 1982 to 1987 period of time, from not from the low here, but from this level right about right in here, from here to here, that rate of return would have been 17% a year. And that wasn't even buying it at the bottom over here. If you bought it at the bottom, it would have been a little higher, but what I'm trying to point out is that in order for stocks to hit new highs, you want to watch for stocks that are hitting new highs, because this one couldn't hit new highs and maintain them for all those years, and your money would have been wasted. And at the same time, I think you want to pay attention to how much money you're willing to risk at any one point in time. And I wouldn't make that a high percentage. I wouldn't make that 25% of my money. If I had $10,000 at risk, I wouldn't probably let my portfolio drop down 2,500 to 7,500. I'd probably have some kind of safety barrier in there, probably to keep it from going below 9,000 even would be kind of a beginning place to start. But even if you did that over here, if you had some of those barriers in place, where this stock was at 91 and it dropped all the way to 49, dropped in almost in half here, there was some time where you could have taken your profit and just waited on this stock. And that's some of the psychology we'll talk about in other meetings like this. So that we went from 1968 to 1982 without really making any headway on this. And then we had a great run from here to here. But I said really we went from here to here, because we probably wouldn't have figured out it was on the bottom there. But there are times to be in certain stocks and times not to be in them. And let's go out another decade and see what this stock looks like. So after it hit that 1987 high right here, let me take my temporary line pin off. After it hit this high in 1987, this stock didn't hit a new high until July of 1997. Can you see that? From 1987 right here to 1997, it did nothing. And you didn't have to hold through that whole time. You could have had some indicators to get you out of that. As a matter of fact, had you bought it on that high at about $44 a share, it wouldn't have been many years later when it was trading for about $10.50 a share. That's heartbreaking stock action if you were to hold it that long. 1987 to about 1999 over here is where it finally got above that level to hold it. It had a run up from 1999 from this low in 97 here. If you'd have bought it right around here and rode it up to this high in 1999, this in historical basis is what they call the .com era. And these, almost any high-tech stock ran through the roof right in this period of time. IBM wasn't considered one of the leaders in high-tech then. That's when Amazon and companies like eBay came public, and they started being the leaders. But IBM was still tech, and it got some of the benefit of that period of time. And so from 1997, I said July of 1997, so about right here, from July of 1997 to this peak 2 years later, this thing grew at 77% a year. That's a pretty ridiculous rate of return and not sustainable. And then you can see what happened to it right here. It dropped from this high of $139 to all, in just 3 or 4 months, it dropped to $98. And then the carnage kept going. Let's go out about a decade and see what happens. 2010. So we peaked out here in 1999, right here. And it took this stock all the way from 1999 till October of 2010, right here. And all that time, had you owned it back here, your rate of return was 0. That's 11 years of getting 0 on your money. I'm not including the idea of dividends. Dividends are a part of the profits that corporations pay out. So dividends would have given you something nice and warm and fuzzy to feel about, but your capital just didn't do much on the appreciation point of view during that period of time. So once it hit that October of 2010, we'll go out till today. There's October 2010. So from October of 2010 right here to right here in March of 2013, that company, that stock price, this rate of return over this span right here was 16% a year roughly. And that wasn't a bad rate of return, but there might have been other options in there. It's hard to tell. My guess is there have been better companies to own. But what happened is when this thing peaked out in March of 2010, right here, until today, that rate of return, or excuse me, March of 2013, that rate of return from March of 2013 until now is minus 7% a year. And that's while this line right here tells you what the S&P 500 and unmanaged index did. That's all the while that index was going upward. And so in essence, by taking the risk of the market, you've lost a good amount of money because you could have had your capital elsewhere. So when we're looking at the stock market, one of the things you need to keep in mind is you want to understand what direction the market is going. And when the market is going up, you want to look for tennis balls and not like for eggs that, you know, drop and slide on the ground. So this company, since 2013, the best I can tell you, this one has been an egg, and it's not one that you would have wanted to have in your portfolio at all. So as you're looking to manage your portfolio and to manage your risk, what you want to do is know how a stock's personality looks when you look at it on a long-term chart, understand whether it's trending upward or downward, and also understand how much of your money you want to have at risk at any one point in time for the possible rewards you might receive. And there's a lot of long-term stocks that have big names like International Business Machine that had periods of time that gave you really high rates of return. But there were many seasons where they earned zero for a long period of time, from June of 1968 to October of 1982, 0% appreciation. From August of 1987 to July of 1997, 0% appreciation. July of 1999 to October of 2010, 0% appreciation. From March of 2013 until today, negative 7% rate of return. That's the rate of return. One day this thing may curve up and give you a positive return again, but today is not that day. So as you look to the future, think about what's my time frame, what kind of rate of return do I expect, and what amount of risk will I take? And I think you're going to find yourself, as a curious investor, having success. Have a great day, and I'll see you guys next time.